Sales of new U.S. home sales unexpectedly rose in October, largely driven by demand in the South, according to government data, although buyer demand has cooled and rising amid rising rates. Joining me now to discuss what these latest data points mean for the housing market is John Lovallo, UBS U.S. Homebuilders Building Products Equity Research Analyst. Let's talk about this number that we got today. Why did we see the spike despite the mortgage rates?
Hey, Kiko, thanks for having me. It's a good question, right? I think what it tells us is that the underlying demand for housing is still very strong. I think interest rates going up can certainly put a pause on that. However, that 3 to 4 million units that we estimate that has accumulated since the global financial crisis is not going away. And I think you couple that with the fact that there's just very, very little existing home supply in the market, call it about 3 months of supply versus an historical average of closer to 6. And to the extent that people are looking for homes, they're more inclined to look at a new home. And so I think that those factors are all sort of at play.
What have we seen in terms of the conversion for inventory? It feels like there's so many homes that you would have seen on the market before these rate hikes went into effect that are now being pushed towards rentals. I mean, can you talk a bit about that transition that we've seen?
Yeah, so I think that, if you're a homeowner, an existing homeowner, and you have a mortgage, chances are that it's below 5%, in many cases below 4%. And when you look at what's in the market today, rates closer to 6.5%, and going back a few weeks ago, 7%. That transition from your existing asset at sub 4% to 7% is a big jump. And I think what it's doing, it's forcing a lot of people to sort of stay put. The first time buyer is still very active in the market, in our view, and will continue to be on the new home side. But in terms of existing home sales, you're sort of locked, if you will. So I think, what builders are doing is using both sides of the coin. They're building to rent, and they're also building for sale. So I think both of those angles will be very important for the new home producer.
And John, you've got a note out, I should say, with a bit of a holiday theme here. All I want for Christmas is rate stabilization. I'm not sure a lot of home buyers that are in the market right now are convinced that stabilization is going to come in time for the holidays. But when do we expect that?
It's a really good question, and it's a tough one. There's been so much volatility in the fixed income markets in general. But what we've seen, which is pretty unusual, is the spread between the 30-year fixed rate mortgage and the 10-year treasury bond has exploded. It went out to 324 basis points. Historical average is about 172 basis points. Now, when we've seen this happen, it was 4 times since the 1970s. So it was 1981, 1986, 2008, and then 2020. It's always been followed by a pretty sharp correction of about 251 basis points on average. So if we use our economist's forecast for the 10-year bond next year, which is 2.65%, and we throw on just that average spread of 172 basis points, that gets you a mortgage rate that's in the mid-4s. Now, I'm not saying that that's going to happen, but I'm saying that it is a possibility that if we can just get some settling in rates, that affordability will be much improved.
Finally, John, when you think about the height of the boom that we saw during the pandemic, certainly a lot of investors were getting into the housing market as well because of the return they were getting. You've got the Wall Street Journal coming out yesterday saying that there's a big pullback. We're talking about roughly 30%. To what extent is that going to dramatically cool things down? And if you are a first-time home buyer, is that actually a good sign, given that a lot of investors have pushed those prices higher?
It's a good question. It kind of works both ways. I think, as a first-time buyer, I think what's most important is that you have levers that you can pull. You can move a little further away from the city. You could, borrow money from mom and dad. You could buy a smaller footprint home. It's a very motivated buyer by life events, marriage, children, and so forth. So to the extent that that buyer can buy, they're going to buy. So I think that the investor being in the market, sure, has taken some of those opportunities away. I don't think the investor is gone by any means. I mean, I think what we're seeing because of the spike in rates is very simply a pause among not just investors, but buyers in general. So I think as things settle down, and we've been fortunate enough to see a little bit of taming in rates. I think as we continue to see that stabilization that we talked about, I think you're going to see investors come back, but also the traditional buyers as well.
UBS's John Lovallo, appreciate you stopping by today.
My pleasure. Thank you.